Welcome to Barchart's weekly series of webinars to help you design, designed to help you, the trader or investor, to better understand a variety of trading concepts, as well as the pages and tools that Barchart provides to help you to make a more informed investment decision. Tough start today. Today's subject matter is chart patterns. Every trader needs to know. Just as a weatherman can predict the probability of rain by certain cloud formations, or a sailor knows that the sea is angry by the tides and wind, today's chartists can rely on certain patterns or cycle of patterns to predict trends, greater confidence in trends, changes in trends, and projected targets of these trends. Hello, my name is John Rowland, and I've been charting markets for over 35 years. Today, I'm going to show you about a dozen or so patterns that I think every trader should know, and as well as a couple of that might not show up in any charting textbook, but they are patterns that I rely on for my personal trading. With me today, always, is my partner and our moderator, Ms. Jean Baker. Hello, Jean.
Hi, John. How are you today? Little
I
tongue-tied in the
am
beginning,
well.
but let's.
Yeah.
We're gonna present a great session for everybody. I'm sure you're gonna show us a lot of things today.
Yeah, I think so. Yeah, I think I'm a little bit more tongue-tied, so to speak. I need a little drink of water. Maybe that's what I need.
Right.
You know, some days that's the way it is, right? Some days. Anyhow, all right. So let's get started then. Just a reminder, folks, that all trading has some form of risk, and that we at Barchart recommend that before you take on any risk, that you consult a professional and qualified financial advisor, and that you understand risk in terms of your own financial situation and your ability to bear risk. And so, for the example for today is that we're going to look at a lot of chart patterns and some things that we could predict or probabilities that these chart patterns could produce. And they're not always going to do that, right? There's no guarantee that what has happened in the past is going to happen in the future. But we will look at some things that will help us to discern or make sure that if we do see one of these patterns and we believe in what we're going to project, that we'll get a greater confidence, okay? All right. Let me switch my tab here. And so here we are at our main page. But so first, let me start is I want to give you guys kind of some generalizations when it comes to charting. First is that I don't want you to overthink it, right? I just want you to look at charts, and if you don't see anything, well, then there might not be anything there. Markets spend an equal amount of time moving sideways as they do trending up or down. So if you don't see something, here's something that you can do. You can change your perspective. In other words, your time frames. In our webinar, multiple time frame analysis, we talked about moving from different time frames to get a greater perspective on the market. Sometimes we need to see a bigger picture before we can understand what's going on at our lower time frames or what's going on now. The second thing I want you to be aware of is that there are cycles to price. There are large cycles and there are small cycles, again, depending on our time frame. And this is as price moves from high to low, or what some folks would call support to resistance or resistance to support. So I want you to think of markets like the tides, right? Think about the tide. It doesn't move from low tide to high tide on one giant wave. No, it's a series of large and small waves that go back and forth that are trending in that certain direction. And that's what I want you to start thinking about, right? Most patterns that we're going to look at fall into two categories. Something called a reversal pattern or continuation patterns. And these types of patterns can help us zero in on these trends, our tides, so to speak. All right. So let's start with the concept of reversal patterns. All right. So the term reversal could be referred to a reversal of trend or a change in momentum. And obviously, if we can discern a trend reversal, that will become more advantageous to us. But changes in momentum as price action transitions from one of our time frames to another will, especially those when we move from lower time frames to higher, that's going to give us a greater confidence in our price predictability, right? All right. So one of the first ones that we can just jump right into is our double top. And let me pull this one up. Okay, a double top. Now, these are trend reversal patterns that can signal a strong resistance top, and the formation consists of two consecutive topping actions, where the second fails to get above the previous high of the first. Okay, let me see if we can widen this out a little bit for you guys to get a little bigger picture. Hang on. Whoops, not that much. All right. Now, there are different types of double tops. There are double tops where our first high is higher than our second high, or there are double tops where we have our highs are exactly the same, or in this case here, where we see the second high has actually gone above the previous high. But again, the key here is that we don't want to see it close above the previous high. And especially when we're looking at higher time frames, or we're looking at all-time highs, we're looking at a very significant topping action. If we're at an all-time highs and we see this failure of price to make a new high or close above a new high, then that is a signal of failure of that trend. And that also can signal to us as a very strong topping or resistance area. Now, a downtrend confirmation can occur when price falls below the low between our two tops. Once price falls below there, then we can make the assumption that we are now in a downtrend. So let me talk about another thing here, and we're going to see this through a lot of today's price action, is there are two ways we can enter in a lot of these formations. We can do what we call breakout entries, right? And chase price as it runs away. That is very common among a lot of traders. But what I want to teach you guys today is patience, right? And that a lot of times that when we get these patterns and when we get these breakouts, the market always comes back and tests or retests where we have these breakouts. Not always, but a good majority of the time. So we're going to see this a lot today. So I want you guys to be aware of this as we walk through a lot of these examples, that we can look for the breakout trade, but a lot of times with breakout trades, the price runs away from us too fast, where we want to be a little bit more patient, right? So again, here is our breakout, right? And you can see in very small time here, there's a little wick here that did come back and kind of retest it. But over a period of time, price did come back and retest this area of this double top. Now look at this. Over a longer period of time, we definitely got a couple other retests of this very significant topping action. All right. So don't be afraid to wait and be patient to look for some topping actions and or breakout areas where we can come back and test them. So let me show you another example. All right. And here's gold. And here again, here's that topping action, that double top. And this one has a deep trough, right? A lot lower than we saw in the crude oil arm. But here is that example of where they did not get above the previous high, right? Didn't even come close to it. I mean, in terms of relative, it's close, but it didn't make a new high, right? Or it didn't test that high. It just came close to it. And so again, we could take a position based on this new downtrend. Again, we probably need to wait for that confirmation when price breaks below the low between our two highs. Now, what would be the opposite of a double top? Well, that could be a double bottom. All right. So let's look at that. And so here's the SPY, the S&P index. And again, remember we showed this chart in the beginning. There is that nice double bottom formation. Now, the formation itself, right, like its cousin, the double top, is a reversal pattern, and it can signal a strong supportive low. The formation usually starts with a very swift price movement to the downside, then a reversal, and then a retracement or a test of the previous low. Again, followed by a quick rise in price. Now, typically this rise in price has the same type of volatility, angle of inclination, that we see on the leg in. And you can see that the pattern itself looks like the letter W. Confirmation of an uptrend occurs when price clears the high between the two lows. Again, right here, and in this case, the S&P, once price got above that high, that would have signaled to you that not only did we have a reversal in price, but now we have a continuation of an uptrend. Now, in this example here, we didn't have a downtrend before we had the doubling pattern, but this now has given us a very significant supportive low. All right. Now, what I want you to be aware of, though, is don't rush to a judgment. All right. Be patient. Don't just jump in there. All right. So here is a nice W pattern, but what didn't it do? Well, it didn't get above that high between the low, right? We wait for that confirmation. We wait for price to break out. And again, we might wait for it to break out and then retest, all right? So another type of bottoming action that we can look at is called a U-bottom. Now, these are typically found after an extended downtrend or where we see the stock has gone out of favor, and that is usually characterized by a smaller trading ranges and a decrease in volume. All right, so let me kind of squeeze this up a little bit for you guys. All right, and let me drag this back a little bit here. And there's that kind of that U bottom here, right? And like I said, they usually are found after the market has gone out of favor. Again, typically after a down trend. And then what we're going to wait for is we're going to wait for volume to start to pick up. Not only volume to pick up, but also see some price action where we take out some recent highs, or in this case, we can think of this like a cup. This big U is, and once we break out of the cup or out of the other side of the U would be a signal that our uptrend is going to continue. Now, let me pull this up in terms of volume so you can get a little bit of better idea what's going on here. Be patient with me here a little second here. All right. And let me scroll this over here a little bit. There's kind of our very small price action, right? No volume at all, right? That's the bottom of our U. And then we get a spike in volume, right? And price starts, right? We're starting to get a little bit of an uptrend, right? And then these blue lines here, if I squeeze this up a little bit, just to give you reference here, these are areas of significant, right, recent resistance or where price broke down. And as we break through those levels, right, again, we want to see these greater volumes, right? Again, remember what I said to you is don't rush to chase price as it runs away. You can wait patiently and see when price comes back and retests, right? So we're going to look for areas where we see retests of where we saw these beginning of these increases in volumes. And again, if I can get above the top of the cup, let me get rid of my volume here and show this to you again, right? Significant highs, and here is a high that was way back here. Once I get above there, that would be a confirmation of our uptrend, right? So again, there's a lot of patience that might be involved in a U-bottom because it takes a little bit longer in time. Let me give you another example of a U-bottom that might not always occur in a bottoming action, all right? I see a lot of questions popping in, folks. I'm going to try to get to all your questions at the end of our session, but I want to try to get through all these patterns that we have today. All right, so here is corn, and I know that this might be a little bit difficult to see. Let me see if I can kind of widen this out a little bit for you. Here is, again, this U bottom that did not occur like we saw in the Kirkland example, right? Here's where we see those falling ranges. And if we looked at volume, you would see decreasing volume. And then price starts to move out on some significant volume, and that would be a signal of a nice supportive bottom and beginning of a nice extended uptrend. Okay. All right. So that's a U bottom. We had a W bottom. So the other bottom that we can look at is called a V bottom. And these ones I'm a little bit more fond of. Excuse me. No, I had it right the first time. I'm fond of these ones because not only these are a lot easier to see, but also they do tend to signal not only a bottoming action or a change in reversal and trend, but there is a lot of confirmation in it if price can get above the origin of the bottom. Okay, so let's see. Let me see if I can kind of make this a little bit bigger for you guys. All right. All right. Okay. So B bottoms, right? The formation is a reversal and trend. It begins with a volatile drop, usually a downtrend, and then a quick reversal in price, right? Big quick reversal in price. But typically what we'll see on V bottoms is that we'll see a very slow and methodical uptrend, right? Not a lot of big gapping moves, and not a lot of big green candles, a lot of little candles. And for some of us, you've probably heard that adage, you know, that bears take the elevator and bulls take the stairs. And here is that example, right? Here's the bear market, right? The price is falling very quickly, and here's the bull market, right? It kind of staircase up, right? Little up, back, up, back, up, back, up, back, up, back, right? So that staircase. You know, one of the other adages that we used to say too on the floor in this context of the elevator and stairs is that bear markets never let you in, right? Because they fall too fast. And bull markets never convince us to buy them because they kind of just go slowly up, right? They never really kind of shoot up on us, right? And so let's look back at this again, right? A lot of small ranges here and, you know, very steady uptrend, methodical uptrend. Now the continuation on this one, the reversal is the V bottom, but the continuation confirmation is if we can get above, again, the origin of our downtrend, that would signal to us a very significant uptrend. And one of the things you can do then is measure the length of the downtrend in terms of velocity, length, and then you can project upwards for target-wise where you think that trend would go. So for instance, in this one, we went from 1260 down to looks like around 460, so that's about $8. So $8 from 1260 would give us 2060, and you can see that this last little peak right here was pretty close to that target. So again, projecting to for some targets based on the length of the last move. But again, look, in this chart, doesn't look like it really convinced us to buy it, okay? All right, so let me give you another example of a V bottom. Right here is sugar, and you know, again, there's that nice downtrend, right? And then a quick reversal, but here again, you see that kind of staircase, right? Leg up, sideways, leg up, sideways, leg up, right? So again, you know, realize that V bottoms are on the upside are very methodical and slow, and they're not going to run away from you very quickly. So you can use a little bit more patience on those ones. All right. Okay. All right. Okay, so that's a V bottom. Now, there's another good trend reversal pattern as price momentum changes from, let's say, an uptrend to a downtrend. Let me show you that one. Oop. And that's called the head and shoulders. And I'm sure a lot of you've heard of this term, head and shoulders, right? And the formation is a series of three peaks, okay? Three peaks, 1, 2, 3, where they rise from a common area. And that common area we're going to call the neckline. Now, the two outer peaks, right, are similar in height, right? And the middle will be the highest. Now, when price breaks the neckline, right, after the third peak, this is a confirmation that we've now moved from an uptrend to a downtrend. Now, one of the things we can do here on this particular formation, again, for predicting price movements, is we measure the amplitude of the neckline to the head, and that's what this arrow represents. And then when price breaks the neckline, we can extrapolate the distance that price will fall based on that amplitude to the downside. And you can see that we can see that in this example here, all right? So head and shoulders are one of the more common ones that a lot of people look for or talk about. They can be kind of convoluted, right? They're not always as clear and accurate as we see in this picture here. So you know, they can be a little subjective, and you kind of have to use your imagination. But the key here is we really want to see two shoulders that are kind of equal in depth, and again, this kind of 1, 2, 3 volatility to the downside. That's really the key for us, right? Now, to the upside, we have what is called a head and shoulders. On the downside, we have something which is called an inverted head and shoulders, which is just the opposite action. And we showed this one in a couple of our recent webinars. One, it was in our Forex webinar, and also in our tools webinar. We're using tools, Fibonacci tools, to help us project potential targets. And I left all this information up here from those two webinars. And here you can see that here's our series of 1, 2, 3. Again, kind of want those shoulders to be equal. And then price, once it broke above, our neckline. Now we did get a little slight retracement in. Again, a lot of times we do see those retests that we could extrapolate the length of our target based on the amplitude of the neck to the headline. But an example we did in the tools section is we looked at retracements and Fibonacci extensions, and we came up with this value. And it was really amazing how it really came right to that Fibonacci number. All right. Okay. So those are some bottoming actions. And let me pause here for a second. I'm going to look at a couple of your questions I set up for the next part of our webinar. All right. So let's see what we got over here. So Richard asks, the M pattern in the crude oil, the double top, would it be better to wait until the retest before taking the trade? So Richard, again, I think, as far as futures traders are concerned, I know that Richard, you are a futures trader. Yeah, I'm not really one to rush with the crowd as it breaks away, because I just have experience. I know that a lot of times I'll get that opportunity. Especially if I'm an intraday trader, I really believe you will get that opportunity to see that retest. Diane asks, what is the best time frame to look for those patterns? Day, week, month, hour, etc. So Diane, we see patterns in all time frames, right? When we talk about in our multiple time frame analysis webinar, we talked about how we want to start at a higher time frame, look at that bigger picture, see if we can find some patterns, and then move to lower time frames, let's say our trend time frame, or a lower time frame where we're going to look for entries. And what you will discover, Diane, is that a lot of times you will see the same pattern even as you go to lower time frames or confirmations of patterns that are relative to each other. In other words, confirmation trend patterns or reversal patterns as you move from higher time frames to low time. That's kind of what we want to look for. Let me answer one more question. Let's see. Aaron out there, one of my regulars. Hey, Aaron, how's it going? Aaron, it says, in your experience, do you find any correlation between the increased implied volatility of an asset in a double bottom chart activity? I would say, thank you, Professor John. Aaron, I think what you might see in a double bottoming price action is what you might see is not necessarily an increase in volatility, but an increase in volume that might lead to an increase into a volatility. Certainly, think about it in terms of the market is waking up, right? Or, the downside price action might have fallen on lack of interest or lack of support. Find that support, boom, and then the market starts to pick up. So yeah, I think you can anticipate as price moves out of a double bottom action or any of these reversal actions that you could see an increase in volatility. So great question there, Aaron. All right, so continuation patterns, right? So let's talk about those, all right? And Let me put this back. I thought I put this up. All right. Aaron, you distracted me. All right. Continuation patterns. Let me talk again some generalities about these. So first, in our cycle of price, right? This movement of price from high to low or in our trends. These are patterns that we'll see after we see reversal patterns, okay? And the significance here is that each ensuing continuation pattern can signal a strengthening of our trend or a continuation of that trend the pattern is found in, and particularly the time frame that we're looking at, right? So again, a continuation pattern in a particular time frame trend would tell us that that trend is going to continue to move in that direction. As long as it has room to run, and it's not opposed by a higher time frame trend or a higher time frame area of support or resistance. And in this case, right, we were in a downtrend, let's say at the daily level, but maybe what we see here is this downtrend stopped and the continuation pattern stopped because we had found support at a much higher time frame level, maybe at a weekly level here, right? So there are different names that we can talk about continuation patterns. Some of the pattern names you'll hear like triangles or wedges or flags or pennants or rectangles or stairs or steps. I mean, there's a whole bunch of different names, and they're all basically the same thing, right? In general, right? Triangles and rectangles are typically found in higher time frames, right? Because they take a little bit longer amount of time to develop. Flags and pendants are usually found in smaller time frames. And again, this is a generality, right? The other generality is that the time frames that you're in, higher time frames, lower time frames, the size of your triangle or wedge or pennant or flag is similar to that time frame. In other words, in higher time frames, you'll see a lot more candles in your formation because it takes a little bit longer for it to play out. In lower time frames, you might see only a few candles, right? So that difference between higher and lower time frames, also the size of your pennants, flags, wedges, triangles, rectangles, whatever, all right? Okay, so let's look at some continuation patterns. All right, so the first one I want to look at is called an ascending triangle. And here's JP Morgan, and let me move this over here a little bit for you guys, all right? And the formation is a consolidation of price where there are a number of similar highs and a series of higher lows. Now, there are differences between ascending triangles and uptrends and ascending triangles and downtrends. Just because it's an ascending triangle doesn't mean we're going to see an uptrend. There are times where you will see price will fall out of an ascending triangle and you will see a beginning or an extension of a downtrend. So there are two things that we can do to help us discern if this ascending triangle is going to be a confirmation of a continuation of a trend or maybe not so much. And the two things we're going to look at is volume and the leg into our candle. So let's look at volume first. So what we want to see is on one of these ascending triangles, and again on descending triangles when we look at those as well, is we want to see a significant amount of volume on the leg in. Now I have put volume here on the bottom, and you can see this leg in, right, that's creating our ascending triangle, has significant volume. That's crucial to us. Plus, when price breaks out of our ascending triangle, we want to see some significant volume. Now, this was a increase in volume, which looks like just a little bit above what the average had been, but that's more significant to us. Again, remember we talked about don't worry about missing out on an opportunity because price is broken away, right? Wait for that retracement. And look, you can see here, we did get that retracement of that ascending triangle. Now, let's move forward, and I'm moving forward into time. And again, I see this ascending triangle, but why don't I like this ascending triangle? Well, I'm gonna let you guys look at it here for a second. Yeah, there's no volume on the way in, right? There's no significant volume. And matter of fact, when price broke out of this triangle, right, we actually saw a drop in volume, right? No interest, right? No new buyers, right? So again, one of the things we can do is not only look at an ascending triangle as the direction that it's going to predict for us. Usually ascending triangles will be in bull markets, but we want to see that leg in, that could give us an idea of direction, and also the confirmation based on volume. All right. All right, so let me show you a descending. All right, I need to go to 1 year here, and I want to tighten this up a little bit. All right, and there it is. Okay, let me move this over a little bit. And let's expand this so you guys can see this really nicely. All right, okay. Whoops, a little too much there. All right, so the formation itself, again, is a consolidation of price where there are a series of lower highs and similar lows, right? And a close below the lows would signal a continuation of our trend. And again, the subjectivity of a lot of these patterns. What I said to you guys is that one of the things we can discern is if we see a good strong leg in. Now, you're going to have to use your imagination here, is right. We don't see one giant red candle. We actually see this in terms of 3 candles. 3 candles where price did what? Gap down, and then expanded down, right? So this is really one big giant expanded range of downward pressure, right? Some of you might say, oh, well, this was a green candle descending wedge. Well, not really, because remember, we're looking at confirmation, and ascending and descending triangles aren't reversal patterns. They are continuation patterns. And again, what we would like to see on this one would be an increase in volume. And if you wanted to go back and look at this, this is back in February of 2020, you will see that there was a big increase of volume as price broke out of this consolidated descending triangle. Okay. All right, let me do a couple more questions here as we whip through some of these examples. All right. So I get a question here is on double bottoms and double tops. Is there a period of consideration? No, I think you know any of these different patterns we're going to look at can be found in all time frames. Again, think about price action in terms of big time frames and little time frames. You could see a bottoming action in a very small time frame, right? That could be just a correction of a much higher time frame downtrend. So that bottoming action could be just that correction or that retest of maybe a higher time frame. So there's no real key point when we look for bottoming or topping actions. The higher the time frame we find them, and obviously that's the more significant in that. All right. I answered Aaron's question. Okay, Wayne asks, how much prediction value is volume preceding the price change? So yeah, Wayne, I think And any of the formations we're going to look at, you really want to see volume, right? This is one of the ways we can look at institutional traders, right? They try to hide themselves. They try to be very devious and elusive. But one thing they can't hide is volume. So volume is a key component for when we look at a lot of these patterns. So regardless of the time frame that we're looking at, we want to see some form of significant volume, either equal to or greater than what we would normally see at those different time frames. So good question there on that one. I hope I answered that one. All right. So I see a lot more questions. I'm going to try to get to them as we move on. I do see one here by Sandra. Let me see this. Sandra said, isn't that a failed head and shoulders on the dollar index after the inverted head and shoulders? So I think what she was saying is, was it a head and shoulders beforehand and then failed? Yeah, it could be. Again, that's the subjectivity of a lot of these patterns, right? But again, watching as price unfolds, as it reaches these critical levels, these head and shoulders, these necklines, and again, this concept that you'll see a lot of retracements or retests in your patterns. Okay, so let's talk about something called a bull and bear flag. So let's look at bull flags first. And these are continuation patterns too. And they're a confirmation of very strong trends, uptrends or downtrends. And the formation kind of looks like a pole and flag. Sometimes the pole isn't as obvious. It might be a gap, or it might be a series of couple candles. Sometimes you need to use your imagination, right? The distinction is that we want to see a rise in price followed by a series of smaller range candles, right? A series of smaller range candles. And typically we see for flags is that these smaller range candles run counter to our trend, right? Pendants, you'll see more of a symmetrical formation and not so much as a flagging formation, right? So this contra trend activity. Again, remember we talked about looking at different time frames, right? If I was in a smaller time frame, I would see a downtrend, but in the context of a higher time frame, this is just a correctional phase of our higher time frame process here, a higher time frame. So one of the things you can do with flags is we're going to wait for price to break above the most recent pivot high. In this case, if I was looking at an inverted flag, it would be the recent pivot low. And when price breaks out, that would be the confirmation of the continuation of that trend. Again, don't worry about missing out on it. I mean, this is a great example. Here's our recent pivot high right on this red candle on our flag. And didn't the market give us an opportunity to get back into this trend? Yeah, it sure did, right? It came back to us, retested it. So don't worry about missing out that FOMO, right? A lot of times you get those gaps on that trade. All right, again, so for Wayne's point, yeah, Wayne, I would like to see a lot of volume on this breakout. I actually probably want to see a little bit of volume in this part of that segment, right? That breakout of the flag formation. All right. So the other thing you can do is you can measure the length of the pole or the depth of your flag. And when price breaks out, you can extend that, extrapolate, and that will give you one of your first targets as price moves above or closes above that last previous high. Okay, so that's a bull flag. Let me show you a bear flag. And this is the 10-year note. And again, this is where I really want to emphasize the difference between flags and pendants is not really significantly large. But what we want to see is that powerful leg in Small range candles, leg out. Powerful leg in, small range candles, leg out, right? Small range candles that it could be contra to our trend, right? And then a leg out, right? And again, notice that all of these leg outs that the market did give us an opportunity to come back and test that entry, right? Come back and test that entry, right? There it is right there, right? Here we come back here. Here's a little flag right here. And again, it looks like an inverted flag, right? Here's our flagpole, and there's our flag. All right. So again, I just want to emphasize here, strong legs in, strong legs out, looking for volume to confirm this continuation of this trend. All right. So let's look at another type of continuation trend, which can go both ways. And these are called symmetrical triangles. And again, the difference between triangles or pennants or flags could be just based on our time frames. All right, so here's crude oil, and let's go back to crude. All right, and let me move this over here. Okay, and make this nice and big for you. All right. So, I mean, this is not a great example, but I think you can get the gist of it. The formation itself, or the pattern, is a series of higher lows and lower highs of equal inclination. In other words, converging trends. And then when price breaks out above or below, right, symmetrical triangles can go both ways. That would be a signal of a new trend if we had been in a sideways action, or a continuation of our higher time frame trend. So in this example here, you know, we kind of see that we were in a sideways action. Yeah, the market is starting to trend up a little bit here. And then when it breaks out, that is that confirmation. Now, again, one of the things that we can do for symmetrical triangles, either bullish or bearish one, is again, we want to see, you know, how we leg into the triangle. And again, the base or the width of this triangle will project your next leg. Now, this is a 6-month chart. Let's go to a year chart, and you know, there's our triangle there. And that's what I'm saying here. This was probably more of a sideways action that signaled the new uptrend. But a lot of times you will see markets will, you know, a symmetrical triangle could go the other way. All right. So let me show you that one. All right. Move this over a little bit more. All right, so again, you know, a series of lower highs and higher lows. And again, kind of a sideways action. This is a weekly chart. Imagine if you were on a daily time frame, you would see a lot of sideways action here, right? Not really seeing any kind of formation. That's why it's important for us to always move out of our comfort zone in terms of time frames and look at a bigger picture. And again, what we said was one of the clues that we can get from these symmetrical triangles is the leg of that is starting to create our triangle. And you can see there's a very strong red candle here in this sideways action. And that would be the clue that I would be more likely to be leaning towards a downwards price action. And then again, we would love to see more volume as we break out. And once price breaks above the recent pivot low, that could be your entry, or you could be patient and wait for that breakout below the base area of the triangle. Okay. All right, so that's a bearish symmetrical triangle. All right, so there's a couple other ones I want to show you, and then I'm going to jump to. I see we're getting close to top of the hour, so bear with me. I think we might go a little bit over, but I think you guys are enjoying this, hopefully. All right, so let's talk about rectangles or staircases. And these ones I like because these are really typical with very strong trends. And we kind of saw that in that V bottom that I showed you before, right? But this is Boyd Gaming, and these are typically found in slow, methodical uptrends, these staircasing type actions. And again, in a generality, these are usually found in heavily traded or very dense, low volatility markets. Now, I know Boyd Gaming is probably not a heavily dense or big volume market, for instance, like a Google or an Amazon. But what we see is uh, these series of kind of sideways actions, right, of equal highs and lows, and that when price breaks out, right, the new, as price breaks out of a ceiling, in this case an upstairs, the the old high becomes the new support, right? Here's a old high, and then we break out, and then it becomes support, right? A series of highs and lows. We break out, we come back and test, right? Equal highs and lows, right? We break out, come back and test. This kind of staircase, right? That, you know, the example I showed you with the bulls take the stairs up, right? But we do see staircases in down markets as well. So let me show you that. Whoops, wrong one. And let's widen this out a little bit. And this is really what we kind of want to see. Let me grab this so you can see what I wrote here. Right? We broke the low, sideways action, come back, retest. Break the low, sideways action, break the low, sideways action, retest. Break the low, sideways action, right? Retest. Break the low, right? Sideways action, retest. So these kind of patterns are really nice because these are usually typical of very, very strong and methodical trends, and it gives us many opportunities to jump into the market on these based on these retests. Now, one of the things that you can look for as far as an ending of this kind of staircase trend is if you start seeing a retest of a retest, that could be a signal of a bottoming action. Or if you see a retest that doesn't test the low, but maybe comes and tests the high of the last step, that also could be a signal that your trend momentum is starting to change. Okay, so I want to show you two more patterns, but I do want to see if I can get to a couple more questions. Let's see. I'm not going to go into options right now in terms of price action. So I see a lot of options type questions. So Richard asked about hammer candles, and Richard, we're going to do a candle chart formations sometime in the future, so we'll leave that for another time. John Luke asks, is there volume and indication, the number of buyers or amount of money? Yeah, John Luke, that's a way we can discern institutional traders. Ron asked, can we use these patterns in lower timeframes? Again, Ron, there's a fractal nature to markets. And yes, you will see certain patterns that are prevalent in higher and lower timeframes. Okay. Let's see. Wayne asks, I heard that symmetrical triangles break down more often occur near the apex, why breakouts will often break out before. That's a great question, Wayne. I would, if I had to think about that, I would say, yeah, that would be my my experience. Yeah, that the breakouts do come before the apex, but the breakdowns do come around the apex. Yeah, that's a great great question. Okay, so let me show you two more patterns, and then we'll finish up for today. All right. So I want to show you two that I rely on that are uncommon, but are certainly not unusual. The first is something I call a 3-candle crash. And this is more of a candlestick type pattern, but it is a pattern you can look for if you are using just regular bar charts. All right. And this pattern can be found in all time frames. And for my day traders out there, my futures traders, Richard, you listening? You will see a lot of these patterns in those lower time frames, 15, 30 minutes, 60 minutes, okay? And the pattern itself, here it is here. Let me kind of blow this up a little bit more for you guys. All right. The pattern itself is a reversal of trend pattern usually, or it can be a change in momentum. And the formation is a series of 3 cascading candles of greater range. And the first is going to be the smallest, and the last is going to be the largest. Now, the body size of the last candle is irrelevant, but the range is. We want to make sure that the last candle is the largest of the 3. We don't want any one candle engulfing another. We want to see this cascading effect, right? This kind of looks like a waterfall, right? Now, what we're going to do is we're going to wait for this green candle to close, right? Don't just jump in when you see 3 candles like this. We got to wait for this green candle to close. And then when price breaks above that green candle, we can risk the bottom of the green candle as our stop out, and we can set targets based on where these 3 candles broke. So our first target would be between the second and third candle, and our second target would be between the first and the second candle, the second and third candle, and the first and second candle. And then if price can get above the origin of this sell-off, right, above here, this now becomes a continuation confirmation. In other words, it'll tell us that we are in, not only are in an uptrend, but we're going to see another leg up, and you can measure the length of your crash to give you a projection to the upside. Now, there is a caveat to this one, right? And if price fails to get above the second and third break between these 2 candles, if it fails to get above there, this will now become a confirmation of a continuation of a downtrend if you happen to see these in a downtrend. So let me just show you the nuance of the third candle in terms of it doesn't have to be a large candle, it just has to be a large range. So this is the S&P, and I know that's kind of hard to see here, but let me kind of blow it up a little bit for you. And there's that cascading sell-off, 1, 2, 3. And notice the body of the third candle is actually smaller than the body of the second candle, but the range is larger, and that's what's significant, right? And notice that in this example, our green candle actually, kind of bottomed out here and then engulfed that. So, for candlestick chart people, that would be a typical engulfing bullish pattern, right? But again, once price gets above the origin of the sell-off, we can measure the length of this price movement and extrapolate that to the future. And this distance, we went from about 39 down to, what's that, 37.20. So what's that, 180, right, 180 points, 200 points. And so the next leg up would be about 200 points from 39. Well, that would be around 41, and surely that was a nice target that you could have gotten out of this trade. Again, one of the things I talk about is just because price runs away, don't worry about missing it. The market usually gives you an opportunity to come back into this trade, and it looks like it did that as well. So let me show you the caveat. Excuse me, J6 Japanese yen. And this is a great example of, right, there's our cascading candles, right? Red candle's the largest, right? Big, large range. And you can see here that price failed to achieve above that first target. It got to the first target, but it failed to get above that. And notice here's our little staircase up, right? Our little candles are slow but steady rise up. And that would be a signal of a continuation of this downtrend. All right. So the yin to the yang of my 3-candle drop will be something that we're going to call pinchers or twins. And these are reversal trend patterns, change in momentum, whatever you want to call it. And on this pattern, again, it is really more commonly a change in momentum. It can be a trend reversal, and you will see it as a trend reversal. And they're typically found at the end of an extended uptrend, right? Or a quick rise in price in a very short period of time. Now, the pattern contains only 2 candles. And what is important for us here, or the key, is that we have a green candle in, an up candle, and a red candle down. And the key being here is that the close, excuse me, the open of the red candle, the opening price of the red candle has to be the closing price of the green candle. Now, I know some of you candlestick formation people will talk about cover clouds, again, engulfing bearish, right? Where you might see the red candle be above, or red candle open above, right? Yes, those are all similar types of patterns. The key to this one is that they need to be the exact same value. And this is an indication of a large institutional trader who is ready to step in and sell as much contracts or shares that you need, right? And they're not in a rush to do it, but they have picked an area where they feel very comfortable selling it. And that this would be the beginning of a new down cycle or a new change in momentum. So let me just show you. And for my Forex traders out there, listen up. This pattern is very, very common in currencies. You see it a lot, usually large institutions like central banks, right? They can't hide themselves. Again, volume could be an indication on this one as well. So let me show you the one example I wanted to do. DX dollar index. And how twins can be very, very significant, especially in higher time frames. Right, so there is a daily chart from a year ago, and you can see that around September of last year, right, kind of a sideways acceleration of price, right? Not really as much of an uptrend, just kind of an acceleration price 3, 4, 5 days in a row, right? And then there's our twins, right? And that green candle's closing price is the same as the opening price of the red candle, and price started this new big downtrend. Again, why we want to be patient. Don't worry that you might miss out. Don't have that FOMO, right? I mean, there is your retest. that allows you to get back into that trade. Okay. All right. So let me see if I can answer a couple more questions before we finish up here. I know that I've gone a little bit over. Jean, is there any questions that you're seeing out there that I missed?
No, just people asking whether they're going to get a recording of this. And yes, you will get an email later on today with the recording to the webinar. We always post these on our free webinars page, which John is going to right now. But before we do that, he's going to go to the site education page first. All of these chart patterns that John just talked about today, we compiled them into kind of like a little cheat sheet for you. Down under interactive charts, there's a link for chart patterns right there. So if you want to brush up on these patterns that John talked about, just look for that page in the education section. And also, when you go to view the recording today, there's a link underneath the recording itself, underneath the video, that you'll see with a link directly to that reference guide as well. So right there, John's showing you on the webinar archive page, this is where the video will be posted later on today, and directly underneath, you'll be able to also get that cheat sheet.
Now let's stop here for a second. You said we did this. Let's everybody give Jean a big hand, because it was really Jean did all this hard work. I just pulled up the charts for her and she did all the work. So Jean, thank you so much for creating this reference guide for our subscribers, and I know that they're going to really appreciate it. So thank you so much for doing that.
Well, you're very welcome. You found the patterns. I just put them together. Why don't you talk about your session for next week?
Yeah, so next week we're going to look at a very particular option strategy. It's called a short straddle. This is a very short-term income generating option strategy. There's a lot of difficulties, a lot of nuances, and a lot of risk in this trade, but it is an opportunity to look at a way to create some income from a stock or an equity that you believe is going to fall in volatility. And what we'll talk about is, we might have heard the adage, you buy the rumor and you sell the news. Well, we do see a change in volatility on some news events, for in particular earnings, where you'll see a rise in volatility going into the earnings announcement, and then after the earnings announcement, typically what you see is a quick fall in volatility. So this strategy is a strategy where we could look for falling volatility to try to make a little bit of money in a very short period of time. So I'm looking forward to doing that one next week. Anything else, Jean?
That's it from my end.
Okay. Well, I want to wish everybody the best of health. Stay safe out there, and the good of all trading.